valuations are low, people are just not buying unless you come in and buy right. And so that gives us the opportunity to swoop in and be the financial relief to operators that are performing assets. These are not unperforming assets, either through debt or equity. And that's where I think right now the opportunity is. If you're in performing assets in recession-resilient markets, and you're making the return on the buy and not hoping, you can't rely on rent growth. You can't rely on appreciation through renovations. It's my take. You can, and I don't think buying from brokers is the best. We're going direct to owner right now because the brokers have been whispering unreasonable pricing and still are. And they're the result of a lot of this. They're trying to save face with the owners and trying to sell things to higher risk buyers for more than they'll pay. And most of the assets we've bought are things that came back on the market after people failed to perform. And so we're doing a lot of talking to the owners directly, ones that are just willing to say, look, they either need a gap transactional or bridge loan. And we're originating like 13%. So incredible returns for debt investors, or I just want out, and we're doing all cash buys, right? Again, performing assets, cash flowing assets. And then we're selling them. We're refining out our capital, buying another one, selling them. And I think that leaning into that take is where it's at. And because in the debt side, that was the acquisition slide on the price side, but on the debt side, you have the relatively lower risk. You have higher returns than most fixed, and it's non-correlated because you have so much cushion between the waning of the market. As long as you're in those recession-resilient markets, even the global financial crisis, if you're in a 50% leverage position, you're mostly fine, even in some of the worst markets, if you're in a non-leveraged debt fund. And you're diversified, of course, because sometimes a Detroit can happen, and they're stable. So the reason why it's so important right now, I think the opportunity in commercial real estate is because banks are under pressure. The regional banks that typically lend on these commercial assets, they're in a liquidity crunch. We have about 8 more minutes, and I'll squeeze this last slide in. But they're in a liquidity crunch right now. And that means just because some details behind how banks work is that they buy bonds. And those bonds that have fixed income are based off lower interest rates. So people don't want to buy them from the bank because they're will pay lower amounts and they can buy new bonds today. So the banks are under pressure because people don't trust them. Deposits are leaving. Their assets, their bonds are devalued. And a lot of their properties that they lent on, people aren't paying, or people aren't paying off those loans. So they're in a liquidity crunch. So they've backed away. This is creating a lot of distress for performing assets. It's creating an opportunity for acquisitions buyers to come in and cash. It's creating opportunity for debt investors to come in and fill the void. And with the debt maturing through 2025, I think this is potentially, as I said, the second most awesome opportunity for us to put pencil to paper and analyze these debt and equity investments and produce some really incredible returns. Focus on financially distressed owners and not distressed assets. And we can reach that lower risk premium during a recession resilient time through those methods. So that's the slides I had.